Hmm. Oh, is it time to do another Q&A video?
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com, answering your questions about real estate and mortgage. And I try to keep these videos to about 20 minutes or so, unless we really get rolling. It's a lot of fun doing these. If you have any comments, questions, or concerns, please post them in the comment section. I'll get to those in a future video. But let's see how many we can get to today. So let me jump on my little list here real quick. What are the benefits of getting an FHA loan over a conventional loan? A lot of this will be based on your down payment. FHA requires 3.5% down, and there's a lot of programs that can help you cover that 3.5%. So it is something where you can get some 100% financing options with FHA. The other benefit with FHA is the mortgage insurance has dropped and is the same regardless of your credit score. So if your credit scores are lower, then FHA can be cheaper for the mortgage loan. But once you reach a certain credit score or a certain down payment, that's where conventional loans can be more beneficial. But they both have benefits and disadvantages. They both have niches they're trying to fit in the marketplace. But I'd say generally it's the down payment credit scores that usually can move you into FHA versus conventional. FHA does have lower loan limits as well. So, depending on your area, you can research or Google FHA loan limits. It'll pull up the county and show you how much it is. It's typically less than a conventional loan. So, there's some factors that go into it. But I'd say the biggest reason why, when I'm sitting down with a client, we kind of talk about different loan options. FHA is usually a little lower credit score and a little less money down. Let's see. Let's go on to the next one. How much home can you afford with 200,000 a year? So we've talked about this a few times on the channel, but a lot of that depends on the other debts. So when you take your income, so let's take that number. In fact, where's my calculator here? So at 200,000 divided by 12. So we have a monthly amount that's $16,667. Divide that by 45%, which is 7,500. Usually all the bills and the new mortgage have to fall under that number. Now, depending on credit, down payment, that can fluctuate a little bit, but generally speaking, 45% of your gross monthly income can go towards the new mortgage, car loans, visas, student loans, whatever other debts that you have. It doesn't count insurances or utility bills or those types of things other than the homeowner's insurance and mortgage insurance if you have it. That's why they use a 45% factor, knowing you've got other expenses out there. Now, I've seen loans go clear up to 60%. I've seen loans not get approved at 45%. So that's a general rule of what you can afford. So just saying, hey, I make 200,000 a year, how much can I afford? It depends on the other debts on top of that expense. So that's where you can sit down with me or give me a phone call and we can review those options. I lend in Utah and Nevada, or just talk with any other lender. If you need help with another state, I have a lot of different referral partners. We have other branches within our company I can refer you to. So we can loan in a lot of different states. But me individually, I'm licensed in just Utah and Nevada. Let's see what else we can get. How can a mortgage broker or agent get the best mortgage deal for their client? A lot of this will be based on having a lot of different choices to fit the needs of a client. Not every client's the same. And we have guidelines for just about everything, and certain programs fit in certain boxes differently. It depends on how you're in your income, your credit score, your down payment, how long you've been on the job, if it's a first home, second home, if it's your rental property. I mean, there's a lot of factors that go in, and there's a guideline for just about everything. So, part of my job is when a client comes into my office to know which lenders will accept their credit file or which ones won't, and then which ones will offer better rates and terms. So, it really just comes down to the client. And that's why having more kind of bullets in the gun, so to speak, or more choices for the clients, we've got more ways of solving their needs. Let's see what else we got. Let's see. Can I refinance or be approved for a refinance if my for my mortgage if my income is lower than I bought the home? Again, it depends. Are the other debts also increased? Is the refinance lowering your payment or paying off some of the other debts? So it's not a hard no on that question, but it could be. If your income's gone down, the debts have gone up, there's a likelihood that you won't get qualified for a refinance unless that refinance is taking some money to maybe pay off some of those debts. So it kind of depends on the refinance, but it's not a hard no on that case, but it may make it harder to do the refinance. Let's see. What kind of loan do I need to buy a house before I get mine sold? That's a great question. So, if you need the equity from your current home to put the down payment on the next one, there is a loan program called a bridge loan that bridges this home with this one. They kind of call it a bridge loan. So, that's one way you can get the equity out to then go buy the next home. If you don't need it for that, you can qualify for both loans. You don't have to sell your current home to be able to turn it into a rental or wait to sell it as as long as you can qualify for both mortgage payments. So that's where it can get a little bit tricky is qualifying for the exiting property while trying to buy the next one. So really just a lot of it will come down to your debt ratio, but there is that option. It's called a bridge loan that can pull the equity out. It's a short-term loan. We have one in house that goes 6 months or 11 months, depending on the situation. Goes up to a certain loan to value, depending on credit score, depending on how fees they pay for, that type of thing. But I tell you what, bridge loans are great because it gives you a chance to maybe get moved out, cleaned out. I mean, if you've been in your home for 10 years, you've got just stuff everywhere. So going through it or yard sale or kind of clearing it all out or whatever you're trying to do, get it pack up, get moved out, you usually get a little better price for your exiting home because you can show it more quickly. You don't have to schedule appointments to go in and out of the house. They can see themselves in the home a little bit more with their personal effects and their decorations or whatever. So I found it's really nice to be able to get moved out of the one house, get it on the market, get it cleaned up, do all the things to present it as well as possible, then be able to sell it after the fact. So we offer those loans as well throughout most of the country. So if you're looking for some sort of equity type loan or this bridge loan, I highly recommend it. It's a really good loan program. And it just de-stresses the whole situation. I can't tell you how many people have got to get out of their current home into the next one the same weekend. They're scrambling to get the one house exited out of. Then there's a delay in the closing, and all of a sudden they have to go to a hotel for a couple days. Boy, it can be really stressful. So don't set yourself up for success. Work with the right team, set realistic expectations, and even just give yourself a little more time. Just give yourself a 2 week gap. Give yourself a little bit more time to get moved into the other house while you're trying to exit out of the other one. So, those are some great tips to just de stress this whole situation. All right, let's see what else we got. What, if anything, can be done if a realtor is forcing you to buy a home? What, if anything, can be done if a realtor is forcing you to buy a home? I don't know. I haven't seen a situation. Maybe put in the comment section. Have you run across a situation where you have to buy a home? I don't think a real estate agent can force you. Now, a real estate agent can have a contract that says if you do buy a home, they're owed a commission for a certain amount of time. It's usually a broker agreement or something like that. But that doesn't mean that you have to buy a home. I haven't seen that situation before. Definitely not in Utah or Nevada where somebody's actually forced to buy a home. Now, maybe forced to sell because they're foreclosure or something like that, but not forced to buy. That's interesting. Okay. Why do mortgage brokers make so much money? Oh, well, because we're good at our job. Maybe that's one reason. So, mortgage brokers, most mortgage lenders are capped at what they make. It's a certain percentage of the loan. And we don't get any extra incentive to sell different types of loans. Like before, you would get incentive to sell maybe subprime loans. You get these bonuses if you push products to a certain direction. I think that's in almost every sales industry. If you're down at the car dealership or whatever, and they're trying to clear out the certain sedan or the certain truck, usually there's incentives and they offer if you sell more of these, you get a bonus or something like that. So it's very similar to other sales types industries to try to push maybe certain products, especially the ones they're trying to go after and trying to fit the need with the clients. They really got away with a lot of that. In 2008, we now just make the same amount on almost every loan. There is some exceptions, but they're very minor on what we actually can make on the transaction. So it is something where it's changed a lot on the percentages, but it is something where mortgage brokers don't make more unless they do more volume. It's really much more about how many units, how many closings they have. That's really determines how much they make. It's not something where it's different on any loan, like an incentive to sell a certain loan because you make 5 points on the deal or something like that. And I would say most mortgage people make between, I've seen as low as a 1/4%, which is crazy low, up to 2%. So there's usually some number in there that most people in the mortgage industry are making. All right, let's see what else we got in here. How are we doing on time? Oh, we're only halfway. I hope you're enjoying these videos. I really do have a lot of fun answering these. I don't pre-screen a lot of these. I just answer them as they come up. So it's not quite live, but it's pretty close. All right, let's see. What is the age limit for subsidized home loan? There is not. You can't discriminate based on age or ethnicity or race or any of that stuff. It's all protected classes. Let's see. Do all mortgages require a good credit score and steady income? Yes, it depends on what you mean by good. So there is ranges. I've seen it go clear down to a 580 score, but a lot of times is why is it 580? If there's a whole bunch of lates, you're not getting the loan. But if you have a better score, better loan programs open up. That's just how it works. How it works for car loans, insurances, everything's tied to having a better credit score. So the more you can work on the score, the better loans open up. But I've seen what I would call below average. I mean, in Utah, the average I think last year was 683. Nevada was even lower. I think it was one of the lowest in the country at like 669 or something like that. And that number changes every year a little bit. But something where when you're under that, you're already considered under average or below average on the credit score. But a lot of these programs go down to 660, 620, even 580 on the credit score, depending again on why the score is the way that it is. But there's so many things you can do within 30, 60, 90 days of kind of fixing and rebudgeting and getting a better credit score. And if you can work yourself up to that next tier, you're going to get a better loan. That's simply how it works. So it's worth the time, especially if you're thinking, okay, we want to buy a house this year. Start talking about it now. Start pulling credits now. Start looking at debt ratio. Start that pre approval process a little early. Way too many times people start it late and either costs them more money to have to update the credit score or they miss out on the better rates because they got to close right now because their lease is expiring or they sign a contract for 30 days to buy the house. But I'm telling you, if you have just another 60 days, 90 days, so many things can be done during that time. The second part of this question is steady income. Yes, they do averages. So a lot of the programs are going to have a 2-year average of your income. And so they're going to take a look at that. If it's declining, there's different guidelines. If it's tips or bonus or commission or 1099 or K1, I mean, there's so many ways people get paid. Every program is going to look at those things a little bit differently. But again, the better steady income, the better the score, the more programs open up, the better interest rates. So working on a few of those things can just help you get a better loan. But I wouldn't wait. I would find out where you're at and where you could be if you started working on a few things. I think way too many people wait and they're missing out on buying a home that can really give them a lot of other benefits as well. All right, let's see. Let's see. What happens to a mortgage when children inherit the home? A lot of times, the mortgage is a lien against the property. And if the person passes away, they can call that note due. So it is something where if it's in a trust or living will, there's some protection of the asset, but the loan itself can be called due if the borrowers pass away. That's where the children would have to either refinance the loan or sell the property and split the equity based on the trust or the living will or however it's set up with the children. So a lot of times, but I'll tell you this, if a mortgage company doesn't have the payments missed, a lot of times they don't notice that something has happened. I mean, it's not something they catch usually right away. As long as the payments get made, a lot of times they just let sleeping dogs lie, to be very honest with you. But the technical things that would happen is they would then give 90 days to be able to kind of keep making the payments. Obviously, if the payments aren't made, that's a whole different situation. But so make sure payments are still being made while you figure out what you're doing with the home. But a lot of times, if the payment's made, the mortgage company will just kind of keep it going, even if the parents have passed away and the kids have taken over the home. But just be prepared. It is something that will have to be sold or refinanced so that loan gets cleared off. Just because the kids inherit the loan doesn't mean they or inherit the property doesn't mean they automatically inherit the loan. Let's see. If you file a bankruptcy, can you keep your home with the reverse mortgage? Most likely, yes. It'll be up to the trustee. It'll be depending on the equity that's there. Just because it's a reverse mortgage doesn't protect it from the bankruptcy. And it'll depend on if it's a 7 or 13 bankruptcy. There's two types. 7 is typically a liquidation of the assets. So if there is enough equity there, which a lot of times there is, the judge may say, okay, I have to sell the home. But a lot of times, if you're qualified for a reverse mortgage, most of the judges aren't going to also kick you out of your home. They may take other assets. So it most likely not, but it could. And if it depends on if it's a 7 or a 13. So a 7 is liquidating the assets. A 13 is restructured payments that go to the trustee until the debts are paid off. In a 13, most likely you'll really keep the home. It's the 7 where you may run into issues where they liquidate the house. But a reverse mortgage is for people over 62. So generally, you're not going to see a judge kick somebody out of their house in that situation. Let's see. All right, how we doing on time? Ooh, we can keep flying here. Hope you're enjoying the videos. Please comment, subscribe, like. Let me know if there's any questions you have about a mortgage or real estate as well. Let's see. What are the options for dealing with the mortgage after retirement? So dealing with the mortgage, I don't know if that's buying or refinancing, so it's a little bit too broad of a question to be specific. But again, if you already have a mortgage, it doesn't change if you retire, still obligated to pay that payment unless you refinance. If you retire, that's where the reverse mortgage option might start to kick in. It just depends on what you owe and that type of thing. But it's not like, okay, I've gone into retirement. Now I can only afford this because my retirement income's gone down. That note is still out there and still exists. So it is something where you'll have to keep making the payment, or you could still lose the house, even if you enter retirement. Let's see. Let's see. Can I get a copy of my credit report from my mortgage lender? Absolutely. You get a copy of that. A lot of times they don't have to provide the scores. That's something that's paid for and is part of the process. But a lot of times they do have what's called a consumer report that will send out that will have all their trade lines and everything that's on there. And then you can obviously ask what your credit scores are. But usually the copy that we get, we don't send out to clients because it's got a ton of confidential information. The last thing we want to do is send that to an email, get it hacked, and all of a sudden that credit report sitting in an inbox or something like that. So we have a lot of security protocols to protect people's information. So we generally don't send the actual tri-merged credit report, but we do have a consumer copy that we can send out that blocks social account numbers, but still gives you all the trade lines, the auto loans, visas, student loans, whatever debts that you have. And that's really important to get, I think, so you can review it for accuracy or review it to make sure if there is something that's wrong that's affecting your score, we can start to work to get that fixed. So ask your mortgage lender for a consumer copy. All of us have it. It's very easy to get to. 16 minutes. We're cooking with gas here. Hold on, almost 17 minutes. Let's see. What's the difference between mortgage loans, mortgages, and mortgage securities? Are they all related to real estate and property lending and borrower activities? Great question. So, mortgage loans, mortgages are really the same thing. Now, the terminology of mortgages can also be how the property is liened in certain states. Like certain states have an actual mortgage that's recorded, others have what's called a deed of trust. So, it depends on how it secures the property, can change the name, but a mortgage is the loan that's secured against real estate. Mortgage securities is these a bunch of loans kind of securitized and put into these big pools and turned into a block of mortgage backed securities. What that does is spread out the risk and becomes something that gets bought and sold as an actual security or commodity. So it's something where it's a little bit different in the sense that you wouldn't go apply for a mortgage security. Your mortgage becomes a mortgage security with Fannie or Freddie or any different lender that gets pooled up with a bunch of different loans. That way it spreads out the risk. So if you have 100 loans in your portfolio, depending on the type of loan, there's only a certain percentage that should default. So it helps to spread that risk out, which has helped keep rates down, mortgage moving. Otherwise, mortgage loans wouldn't be as available as they are today, quite frankly. If it wasn't for mortgage-backed securities, you would you'd have lenders just run out of money. They'd just be loaned up, is what it used to be called, where your local bank or credit union just say, nope, we're out of money for mortgages because there's such a big chunk. Car loans or I mean, you could do how many car loans for one mortgage loan? So, as this mortgage-backed security was a way to be able to kind of securitize these debts to then be able to pool them together to minimize the risk and to sell them off to bigger banks. So that's their little different terminology there. How we doing? Oh, I try to keep these about 20 minutes. So let's see how we're doing here. As a new homeowner, how long should you avoid taking on additional debt? That's a really broad question. It depends on your budget. It depends on your income. It depends on why you're taking on new debt and if it's eliminating other debt. So it really just kind of comes down to it's probably maybe a new car loan or something like that. But as a new homeowner, it really comes down to your budget. Budget, budget, budget. Know where your money's going. Where are some places you can cut back your expenses? If you're going from renting to owning, you're usually going to see a budget increase. So maybe it's good to maybe give it a couple of months just to make sure your budget gets used to that bigger payment. The last thing you want to do is go get new car, furniture, house, all these things, and have your budget go from 1,000 a month to 5,000 a month or something like that. So I think there's probably a good idea to give it a couple months to just make sure you're settled. There's also things you're going to want for your new home. Maybe there's furniture, maybe there's drapes or blinds or landscaping or that type of thing. I think it's good to kind of give it a few months, maybe 6 months before I take on anything major, unless your budget just allows for it. Or if you're replacing something, if you already have a car payment and you're getting another car and it's going up a little bit, I think that's where it can make sense. One of my best tips is having 6 months worth of expenses in the bank. That way, if you lose your job or something happens, you've got that to fall back on. If you're basically barely able to make your payments and now you're trying to add more debt, you're setting yourself up for failure, and you're setting up to be just house poor is what we there's a term out there you can research called house poor, that you can't do anything. You can't enjoy life, you can't go on vacations, you can't do the other things. So know what your budget is, know where your money's going. And if you just became a homeowner, give it a little bit of time because you want to get used to those expenses. Maybe the utilities are going to be more and you're covering more of them than you were as a renter. You've got more expenses typically with a home. So give it a little time before you add a bunch of additional debt. Ooh, we just hit the 20-minute mark. So that's all we got. Got more questions here, but we'll just get them for another time. But I really appreciate your time watching the video. Um, excuse me, it's allergy season. My goodness. Um, Let me know if you have any comments, questions, concerns. Love to answer any questions that you have. If you're looking for a home loan, I can help you in just about every state. I'm licensed in Utah and Nevada, but our company has branches throughout most of the country, or I have referral partners in many, many parts of the country, and love an opportunity to help you. We do every kind of mortgage loan you can think of, and some you don't even know about. So if you want to find out what you're qualified for, find out what your payment would be, let's sit down and talk. The biggest thing I tell people is get started a little bit sooner. I know it's changed. I know the market's changed. Interest rates are up. There's a lot of scary reasons to buy a home, but the benefits of home ownership, maybe they've lessened, but they haven't gone away. It's one of the perfect fixed rate payments you're going to have where rents have done nothing but gone up. So it's something where it's still worth finding out. Now, maybe you can only afford 2,500 a month, and maybe that was higher a year ago than it is now, but it hasn't gone to zero. You may just have to be more patient on what homes are out there, but you have more choices than you had even a year ago. So find out what you're qualified for. Owning a home, being a homeowner wins in the long run. The tax benefits, the financial benefits over the long run, locking in your payment. Ask anybody over the last 5 years how much their mortgage payments increased. There'll be some increases. Taxes, insurance change a little bit, but it's so much less than rent. Rents have been going up like crazy since like 1980. Do you think they're going down? No, as home prices go up, rents are also going to go up because the cost to maintain that home goes up, or the new mortgage of the new buyer is more than the previous owner was. So it's a highly likely chance that your rent is going to go up. So why not start being a homeowner? So I'm a big believer in real estate. I own a bunch of real estate throughout the country, a lot of rental properties. I'm telling you what, homeowners win in the long run. So let's help you get into a home by getting pre-approved today. So check out my website, ryanbolton.com. You can schedule an appointment on there. You can call me, ask any questions. Even if I can't help you specifically, I'll definitely point you in the right direction. So hope you have a wonderful day, and we'll see you next time.